Good evening, it's Quant Trade Edge. Today I was just following up on yesterday's video, which had one of my favorite market bottom timing indicators, and that is the spikes in volatility, specifically the VXX and specifically the 2 period RSI. And, we were up here yesterday, and you can see that this has come back down, and we tied that to the SPY, and basically where we were in this pattern was back testing the breakout. So this is the high, this is where we broke out, and we broke out, retested and bounced, retested, broke, but we're coming right back through it. And the conclusion we came to, given this pattern here, and this line I think was a little bit lower yesterday when I drew it a little more precisely. Let's see if I could recreate that here. Price 57. Okay. Yeah, that's right. I took that part off. Perfect. Okay, so basically this 3-4 bar overlap was right on the trend line. So I basically said that whichever way this rectangle breaks is going to be our direction and our trend. And today that was solidly up. And, to support this pattern in the SPY, the QQQ also had a 2B pattern. That's Niederhofer's 2B pattern, where once you take out the high of this bar which pierced, which happened over here, this is now a powerful bottom. And really, I think a very conservative target for the Qs on this move would be the 1.272 extension around 321. And, we're just under 307 today. So ideally, what I'm hoping is we get a little bit of a pullback tomorrow, probably to this high, 304. And that would be a load the boat zone for the move from 304 up to 321 in QQQ. So, as bad as sentiment is, everyone thinks banks are dropping. This is not actually a credit situation. It was more an interest rate situation, and the market is self-regulating. If rates were to go up significantly, yes, that exposes more balance sheet trouble, but each time we had one of these, down market days where the banks were having their issues, we would have a bounce in the TLT, which brought rates down. And the big thing that's happened now is treasury rates have come way down. And I'll see if I can find this, the yield curve inversion. The Federal Reserve has a good chart. Fred. I just type in Fred here. There we go. And you can see that something major has happened. Basically, we were making new lows in the yield curve, and I believe these are new all-time lows. If I were to open up the time back to 1980, okay, no, they've been lower in 1980, but what ends up happening is when this turns, you typically have a few months before the recession kicks in. So like here, when this turned up, the recession wasn't until about 6 months later. When this turned up off the low, the recession wasn't until, let's see, March of 89 to May of 90, 15 months later. Here again, the yield curve turns up, the recession is later. Here, the yield curve turns up, the recession is later. These seem a little more concurrent, the ones in the early 80s. But I think that we have about 4 to 6 months before the recession really hits us in earnest. And what that essentially does is it gives us some clear room to rally. And, I'm not saying this is a fundamentally wonderful rally, but it doesn't matter. Technically we have broken this downtrend line, which was our bear market from, say, January of 22 to January 23, about a 13-month bear market, broke out, retest, and we're going. And I would not be surprised if we saw new all-time highs. And I know that is a contrarian view at this point, but the sentiment is so horrible, and we have this 4 to 6 month window that I think we could achieve this. And then I do think it gets particularly ugly after that. So don't forget, to sell. But anyway, that's just what we had today. Again, the volatility timing indicator, perfect, tells us when the tops are. And then just the rest of it is putting the chart into context and seeing that we had this breakout, we had this consolidation around the back test, and we found our little rectangle, and today is really just day one of the breakout. So I would not be surprised to see us pull back a little and even go higher tomorrow itself. So that's going to be a nimble buy, and what I actually prefer is the Qs. It's doing better, and when you go to the Qs, you always have to look at the semiconductors, and that's doing even better. If we put our 200 moving average onto this, we are well above the 200, and the 200 is now flat to actually up. So those are good signs. This is, essentially where Paul Tudor Jones would be buying. He likes to see the break above the 200. He likes to come back and see the retest of the 200. This, didn't really retest, but the slope is turning. MACDs are turning. So now I believe is the time you would go risk on things like semiconductors, Qs, and then monitor it closely. But anyway, just wanted to follow up. Timing was pretty good on the call yesterday, and just want to keep people's heads, on the chart, not focused on all the news about banks and all the speculation of further banks failing, etc. Anyway, have a good evening.